Most people we talk to feel stuck. They'll tell us things like, I feel behind. I wish I had more time with my family, or work is draining me. Does that sound familiar? The truth is, it's not that you don't want freedom. You just don't have a clear system to get you there. And without a system, what happens is 3 years from now, you're very likely to be in the same place that you are today. Your kids are going to be older and they won't care that your business was more successful. They'll just remember that you weren't there.
That's why we built the Passive Income Operating System. It's the exact framework we use to design financial freedom for ourselves and for our clients, not decades from now, but today. Now, the system isn't free, but the training that shows you how it works is, and it's less than an hour. So go to infinitewealthconsultants.com/PIOS, PIOS, and take the first step to buying back your time, creating passive income, and designing the life you don't have to retire from. I mean, can you imagine, Cameron, if one of your clients lost 50% of their cash value? That's when it opened up my eyes to really reading what the heck is in these things.
If you're an investor or wannabe and you're ready to build passive income that exceeds your monthly expenses, you found the right podcast. Welcome to the Infinite Wealth Podcast, where we combine the wealth building principles of Rich Dad Poor Dad with the power of the infinite banking concept to help you take control of your money and your future.
Join us as we bring insights from experts and from Cameron, as well as real-world strategies and proven tools to help you create financial freedom without relying on Wall Street. Let's get started.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christiansen, along with our co-host Anthony Faso. And you guys have probably seen the headline. Unfortunately, NASCAR champ Kyle Busch has sued Pacific Life over $8.6 million tied to an IUL policy. You guys, if a celebrity family can get burned, why can't you? And what should you be watching out for in your own plan? Anthony, why should listeners care about this lawsuit with some celebrity?
There's a few reasons, Cameron. For one, if this can you would make the assumption somebody who's making these multi-millions of dollars has access to the best advisors and advice. Yeah. And with that access, they're losing $8 million is the deal of this lawsuit. And if it can happen to them, why could it not happen to you? And also, I think, Karen, this is probably the most one of the most reoccurring topics that we have on here is warning about IULs. And I will say, it's one thing. Let's be honest. If we're a whole life guys, and we're trying to sell life insurance, and if so, you need to take what we say with a grain of salt, because are we just saying this to fill our own pockets? Are we or are we doing what we think is really best for the clients? And so it's one thing if it's coming from like a salesperson, but what Kyle and his wife have done is really put themselves out there. They have nothing to gain from putting this out here, and they just want to spread the word so this doesn't happen to other people. They actually made a very nice social media post with a video, which we're going to include in the show notes. So again, this is from somebody who has no skin in the game, giving you these warnings. So that's why we wanted to continue to warn people on these IULs. But Cameron, what's the risk if our listeners ignore this warning as well?
Yeah, great question. The risk is we end up in the same position that these individuals, this family is, unfortunately. We've seen it time and time again, which is very difficult for us to see because, man, we're out there singing this song for so long, right? We're trying to warn people about some of the shortcomings with this product. And to be honest, what ends up happening is we do see people that do end up getting into these policies, and it ends up being very, very difficult for people to walk away. I'm going to touch on that a little bit later, share a story with you guys. But man, one of the things that we preach here is all about education, right? And so we're positioning IBC as a store of cash and then let's go make investments into businesses and or real estate. And before we ever make that investment, what we talk about is educating yourself on the risks and the benefits of that investment. And I think that far too many people will step into the insurance realm without doing the proper due diligence or the proper research themselves on the different types of opportunities that are being presented to them. So as we get started, Faso, let's kind of tee this off. And how about you tell listeners, if somebody doesn't know what an IUL is, maybe give them a brief overview.
Yeah. And you know what? If you do have an IUL, at the end of the podcast, we're going to give you some options or some solutions for you to minimize these risks. But what, in essence, if we go way back, I mean, there was just permanent whole life insurance, but one of the obstacles of that to insure your whole life, premiums are large because it's a long risk for the insurance company. Because this type of insurance isn't will it happen? It's just when it's going to happen, right? You get car insurance. Hopefully you don't get into a car accident. But with life insurance, it's just a matter of when before we pass. And so to kind of minimize things, to get some more coverage for people, that's when they created term insurance. And term insurance is just like renting a death benefit. Premiums less expensive for the death benefit, but we only have it for a certain amount of time. And then what had happened typically in the 70s and 80s, interest rates were really high, the stock market was doing well, and then you just had this boring old whole life just chugging along. And so salespeople were just they couldn't compete with the stock market or even there's very high interest rates. So what they did is they came up with a universal life, which in essence is term insurance, 1-year term insurance, and then a side fund. And it first started out where that side fund was just given a certain interest rate that may be variable. But then they added on when everybody started chasing the stock market, that's where they created variable universal life, where now that side fund is directly invested in the market. So, but then what had happened when the market tanks, which it will do, so was the cash values of their policies, and it was jeopardizing the validity or the strength, the longevity of these policies. So then the geniuses came up with called an IUL, indexed universal life. And it's still a 1-year term insurance, but that side fund, what they're doing is they are investing in the market by buying options. Meaning, because a lot of the times the way it's sold, and it sounds super cool. Hey, you put the money in this policy, it's going to grow tax-free. If the market goes up, you get to enjoy in the market. And then when the market goes down, you don't lose money. I mean, how many times, Cameron, have you heard someone say, well, you're not going to lose money in a IUL? And you really need to peel back on exactly what that means. In essence, what they're saying is if the market underperforms or is negative, your crediting for that year is zero. So there's no gain or no investment loss, but there's also expenses in these policies. These universal life policies are heavy on fees and expenses. So your earnings might be zero, but when they include all of the expenses, the amount is going to go down. And I would say I fell for this. I had a VUL years ago. It was sold to me as a quote unquote rich man's Roth, right? Where I couldn't put money into it. This is when I was lost, Cameron, when I was still following traditional advice.
I was surprised you fell for it, man. You're the smartest guy you know.
Ditto, right? But it sounded good, right? I mean, hey, you have the joy of the market, and it's tax free, and there's a death benefit. In many states, it's asset protected. Sound like a no brainer until it wasn't. And then when the market tanked in 2008, and I lost 40 to 50%. I mean, can you imagine, Cameron, if one of your clients lost 50% of their cash value? That's when it opened up my eyes to really reading what the heck is in these things. But the bottom line is they're promoted with minimizing risk. And we're tried to educate people, and we have a whole resource page on our website. If you go to Infinite Wealth Consultants /IUL, Cameron, let me spell that for you. Okay. It'll be /IUL. And then in there, we do comparative illustrations on a whole life to a IUL. Very interesting how you would, on where the numbers are going to be. We also, but again, don't take our word for it. We also have white papers from different resources explaining the risks of IULs. And here's a little interesting thing with the IULs. They have what's called a cap, meaning you can only earn your cap on how much you're going to earn each year. What that means, if the market will sometimes do 20 to 30%, but if your cap is 12, you're only going to get to 12. And even when the market tanks, maybe you don't get any interest during that period. But we did the math. What if you what do we take the stock market, and then we compare, then we cap it, cap the wins and cap the losses. And again, you will be surprised on what you're going to find there. But again, this is just us talking in theory. Cameron, have you come across or want to share a story that you've come across with a client, with an IUL, with a real life example?
I almost said happy to, but unfortunately I will share. And man, I saw the Kyle Busch article come out earlier, and I would have bet money that it was Pacific Life, because I've seen Pacific Life time and time again over the years, along with some other IUL carriers. And the backstory here that I'm going to share with you guys is I had a lady that called in several years ago now, but she was sharing with me the frustrations that she had as she had purchased an IUL from a family friend that was kind of helping them manage finances. And she'd shared her story with me. Awesome couple. They had started a business many years ago, struggled for a while, business took off. And so now they're in a position to start putting money away. And they started putting quite a bit of money away into a UL. And she said for the first couple of years, it wasn't no problems, actually pretty good. Advisor was talking to her, they're getting together, having checkups. And then after a while, she started to notice that the policy was not performing as he said it would, nor as it was illustrated. And so she started asking questions as to why that was. And she felt like she kind of got shut out, stopped answering her emails. They stopped talking. And then she was kind of left searching for answers. And so that's where she reached out to us. And so she shared with me kind of the most recent statement that she had. And it showed an overall or an annual statement with not only what was earned in the policy, but also what was paid or charged in fees. And so that's what I'm going to share with you guys here to take a look at this. So if you guys look at this is a Pacific Life policy. She'd had this for several years. And if you can see, it's not a great picture of this, but she's got several $100,000 of cash value in this policy. Nice. And again, her question for me was, I'm being told that this policy is performing well, but yet the numbers that I look at don't make sense to me. And most glaringly, as you can see up here in the right-hand corner, she's getting a statement and then says that her policy's average interest rate is 2.23%. So I'm like, all right, so let's do some math. So we start looking at the crediting of her policy. And in fact, she did earn, just over 2%, which many could argue is not very good, but at 2%, she did earn about $15,000 in her policy, and that's what was earned, credited to her account. So technically, like you said, Anthony, is when they promote that the policy will not lose value, she didn't lose value, right, on the cash side of it, but the fees also continue to add up and accrue annually. And so if we look at the fees that were charged in this policy, she was actually charged just over $40,000 in fees over a 12-month basis. And so
wait, Cameron, how much in fees?
over $40,960 is what was charged in policy fees.
Okay, Cameron, you mind if I want to ask you some questions here?
Sure.
That's a lot of money in fees. I mean, but what's her death benefit?
Her death benefit is $4.8 million.
Okay. So let's just say $5 million. And Cameron, I know we don't do a lot of term insurance per se, but so we don't know like what the rates are. But again, and I don't remember how old this woman is, but could she get $5 million of term insurance for under 40 grand?
She could. Yeah, she was mid-50s and in good health. Yeah, I think $5 million.
Right, so the term insurance really may have been 5-10 grand. I mean,
easy, yeah.
I mean, geez, and she earned 2%. You don't need to round it of 0.2 to give her a little extra. But what year was this?
This was 2021.
Okay, so I'm looking 2021. Oof. The Dow Jones with no dividends was 21%.
Wow.
Right? The S&P 500 with the dividends, which is kind of the benchmark, 28%. And she earned 2.2 in a year. The stock market did 28.
Yeah.
Okay, so I just wanted to make sure that those numbers were correct. That sounded a little crazy, but I'm sorry, Cameron. Go ahead.
Unfortunately, I wish I had kind of a happy ending to this story with this client, but I went through this policy. I showed her exactly kind of where it was performing, and she felt like she already knew it. I was just reinforcing kind of what she'd already figured out. And the tough part for me, I think about this lady often, every time I see one of these headlines, is because unfortunately, this lady could not make the decision to step away from keeping this policy. And so I've checked in on her over the years. She still has it. She emails me every time we do a podcast on IULs and says good content. And but unfortunately, it doesn't have a happy ending. So, maybe this is the reason to reach back out to her and see how she's doing. But unfortunately, this is the reality of the policies that we see, right? Is we call them half-truths around here. Right. If somebody's promoting the fact that this policy can't lose money, they're talking about that cash side of it. And again, they almost always overlook the cost, the fees, the surrender charges. And so that is reality. That's kind of what we're looking at.
Cameron, what was you mind me asking what the premiums were on that policy?
Good question. It's been a couple years, so I don't remember, and I don't see it on this page that I have up. So I'd have to do some research.
I could go because one of my concerns are, with 40 grand of expenses, I mean, if she's not putting in at least 40 grand, well, let me make up for the 2% return. Okay. But, it sounds to me that it's possible that those fees are going to be more than what she's putting in each year in premiums, which means the cash value will continue to go down. And she's at the young age in the 50s, right? What about that cost of insurance when she's in her 60s or 70s or 80s? But Cameron, maybe this is a good segue. What are some of the key concerns that we have with IULs?
Sure. Great question. And again, I'm going to kind of tee up our resources that you referenced earlier, Infinite Wealth Consultants /IUL, right? Is because in there, what the main things that we talk about, number one is complex product design, right? So if you go in and you actually try to read kind of how this policy or understand how these policies perform, very complex, right? I think in a couple of our videos, we talk about, man, I know I shared this, is that I've been in this industry for almost 20 years, and I read these products and I have no clue what's going on or how they're to perform or anything else. And so, right, is I know that most people buying them, again, don't have a clue on how these things perform. So very complex product design. And then the second point that I would highlight here is an area of concern would be misrepresentation on illustrations. Anytime that somebody puts an illustration on IUL, is you have three different kind of illustrations that are presented. You have kind of the low, a medium, and then a high. And they're always quoting the high, right? The high returns. And if you read into it, man, at one point, there were several years there where people were illustrating 7-8% returns annual on an IUL and telling people that that's what they were going to get.
And I've seen 12.
Oh my gosh.
12.
The realtor that I bought my house from way back when, is he had an IUL. We started talking and he was at like 9 or 10. And I remember running down to age 65 and it projected him having like $12 million in cash value. And I was like, you know what? I'll tell you what, if I dig into this and this is the case, I want some of this.
Yeah. That's like, yeah. Give me some.
Right. This looks amazing. Like I would love to have this. Right. But the reality is, unfortunately, they always fall short. And so the projections look great early on. But again, you start to look at, this client situation and you start to look at how a policy actually performs closer to, retirement age. And as you mentioned, 65, 70, 75 is, man, these products just start to implode at that point. So very, very misleading. The third point that I would add on is there is the hidden costs, the policy charges, and the surrender fees that are associated with IULs. 2 points I would make here. Number one is I always tell clients that you need to read the policy. Mm-hmm. So if anybody's ever in a competitive situation, what I tell them is take a whole life product and take a IUL policy and just read them, right? And just go through with a Reddit highlighter. And every time that you see fee, load, or charge, just highlight that, right? And you're going to get to the first 4 or 5 pages on an IUL and the whole thing is going to be drawn up in red. You flip that over to a whole life policy and you might have 2 or 3, right? There's a stark difference between the way that these policies are constructed. And even bigger picture, what I would say is that whole life products put all of the risk on the insurance company. And the insurance company is there to mitigate or kind of soften or take any of that risk away from the client. And so the client is there just receiving these very steady returns and increases every single year in their policy. With an IUL, the insurance company, again, read the contract, is pushing all that risk out over to the client, and the client is absorbing all the policy fees, all the policy charges, and even that volatility that the stock market and that cash account is mirroring. So again, very different story when you start to compare the two products. So Faso, what about you? Do you got any examples that you can share?
I have many, unfortunately, just like you said, but what I'm going to do is I'm going to share a recent case where we had something similar. This was to me, it was very interesting because a lot of times we're not really looking, and we're just looking at the statement. Hey, our cash value increased. Okay. Well, hopefully it does with an IUL, but I kind of went in a little bit of the weed, surprisingly here, but her beginning balance, let's just say, was like 110,000. She put in about 28 grand in premiums. So the total beginning balance was about 138 grand. But when we looked at her fees, the fees were 5 grand, and the interest she earned was 4 grand. So she actually had a loss of $1,000. But what are most people looking at? Well, I started with 120. I started with 110, and now I have 137. So it sounded like I am ahead, right? But we're not accounting for the amount that we put in and if we look at how little she earned Well, she actually ended up showing a loss, right? But we had a loss in a year where the stock market, where the S&P did 23%, and even the Dow Jones did 12, nowhere near what she was expected. And fortunately, I had the original illustration. And at the beginning, the projection was that she'd have about 118, but she only had 109, right? So that's about a $9,000 difference. So she only had 93% of what was projected to be. Okay. And that was year 4. But we look at year 5. At year 5, she was projected to have 154, but she only had 137. So that's a difference of almost 17 grand. Now, by year 5, she only had 89% of what was projected. And if you're that behind the game in year 5, where do you think you're going to be in year 15, 20, or 25 when you are expected to utilize this? Particularly, most time we're using this as a retirement option, but that's when we need it most. But if we're already behind the 8 ball in year 5, it's only going to be worse when we're 65.
Well said, Faso.
Now, for listeners, I mean, a lot of times we're talking about infinite banking here. So, Cameron, why do so many IBC practitioners are so adamant about using a whole life compared to an IUL?
I would say that if you look at kind of the upper echelon of kind of IBC practitioners, I would tell you that none of us really got into this industry with the intention of being a financial advisor. Most of us were entrepreneurs, business owners, and kind of stumbled across infinite banking and then started sharing it out of obligation. And so I think that most of us kind of came into this with maybe some investment background on doing due diligence and reading it. So I think that probably is what has separated maybe that kind of core group of advisors that have been doing this for a long time. The other thing that comes to mind, Anthony, is that, man, Nelson Nash, right? The guy that created the infinite banking concept laid this out in his book, right? The book that he published in 2000 on page 39, Becoming Your Own Banker, addresses this. He has a whole section. It's called My Thoughts on Universal Life and Variable Life. And he says, I never sold one of these policies and I never would buy one. I do not recommend using it for the infinite banking concept. And that's 20 years old. And in light of what has recently happened, the Nelson Nash Institute also put out a statement earlier this week that I'm going to read. I'm going to summarize. I'm going to go all the way down to the bottom. Maybe we'll include this in the notes in this episode as well if you guys would like to read it. But it says, in summary, Nelson Nash's philosophy was and remains grounded in simplicity, stability, and guaranteed performance. Qualities found in dividend-paying whole life insurance, not in IULs or other flexible policies. His vision for IBC is built on predictable performance, disciplined cash flow management, and the enduring strength of mutual insurance companies. So the message has not wavered one bit from day one all the way till now. They're saying the same thing, and we agree. One of the statements that we'll often share with clients is, you want to invest in investments and save in savings. If anybody is positioning IBC as anything other than a cash management system, anything other than an alternative to cash, in my opinion, it's misleading. So, Faso, if somebody's out there listening and they do have a policy, maybe an IUL policy, what should they do now?
Okay, so there's many options, and probably one of the most, the easiest option is you can do a tax-free exchange, kind of like you do a rollover from an IRA from your 401k into Schwab or Fidelity. It's just a tax-free rollover. We could easily do that into a whole life policy. And then that cash value you've built up, that goes into the new policy as a paid up additions. So we're starting with cash immediately. Now, when we do get a new policy, we do need to go through underwriting again. but assuming that you can, that is a quick and easy way to make sure to save those expenses and those potential losses. But as Cameron, you'd mentioned, one of the aspects of this product is there's a lot of fees. There's also surrender fees or surrender charges that typically go out to about 10 years. And oftentimes people, they don't want to absorb that loss, and they will keep that policy knowing how bad it is, because they don't want to realize that surrender charge. Okay. If that's you, one option could be is you lower the premium to the minimum, so we're not putting any more money into it. But if that's something you are considering about, if you're focused on the surrender charge, you need to focus on the unsurrender charge. And what I mean by that is, if you keep this money locked in, this IUL in the high fees, that means you can't use it to do something else, right? And Cameron, like what you're talking about, we are the policy, your cash value should be a safe savings, not an investment. We leverage against the savings to do an investment. For example, here is a example of a client who didn't want to realize that surrender charge. So he did lower to the minimum, and then he was waiting until the surrender charge was he only had 3 years left on the surrender charge. But then when we kind of looked at it, let's not just look at one part of the equation about the policy. Well, what if you do roll it over, and you absorb that fee? What are you losing? And with this example, he was doing some investments where he was earning between 9 and 20%. Now, I know sometimes that might sound high, but if you look at flipping raw land or doing the slow flip or flipping websites, those numbers are not unobtainable. But what we did is we looked at, well, you know what, this money tied up here that you're not touching, you are losing money because this would allow you to do some more investments. And when we ran the math, Cameron, he would have been able to recapture or make up for that surrender charge in 9 months.
Nice.
So instead of him waiting 3 years, he was in the same spot in 9 months. But then we moved it, and now he had 2 more years of doing some additional investments. And another strategy sometimes that we've done is we will take down the premium to the minimum, and those additional premiums, we move that into an infinite banking design whole life policy. So the cash flow is the same. Then what we do is we take a loan from that IUL, and then we put that as a one-time PUA in that policy. So that policy is still going. And then by the time his surrender charge was over, then we canceled the policy. And then he with the cash value he got from that, we had designed room into a second policy to be able to hold room for that additional deposit. But if you do have an IUL, believe me, I was there with you. I had something similar. So what we've often found is these illustrations are complex. People don't really understand what they have. So what I'd recommend you do is let us take a look at it. We can interpret it in English, what it is you really have and the pros and cons, and then you can make the decision on what is best of your family. And I would also encourage you to check out the free resource at Infinite Wealth Consultants /IUL. But the bottom line here is that there's some risk in this product. And if you have one or considering one, you need to do your due diligence. Check out our resource. check out that video from Kyle Busch, and this will allow you to make informed decisions.
Well said. Anthony, I also will have a ton of respect for the Busch family for kind of putting their scenario out there. Man, losing money is not fun. Losing $8.6 million again is probably a nightmare. And so to be able to put it out there for everybody to see, hopefully there is some good that comes out of it, and some people do avoid that option. So again, well done, Faso. Hope you guys enjoy this episode.
Go make it a fantastic day.
Take care.
The opinions expressed on this podcast are solely those of the hosts and guests and do not constitute financial advice. Always consult a licensed professional for professional decisions.
Thanks for listening to the Infinite Wealth Podcast. If you enjoyed today's episode, be sure to subscribe so you don't miss future conversations on building wealth and creating passive income.
You can learn more about infinite banking and get additional resources at infinitewealthconsultants.com. Until next time, keep investing with intention, and remember, your financial freedom is within reach.